Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, funding a startup with a self-directed IRA. This is a topic that's gotten a lot of attention over the last 10 months or so with the Peter Thiel Roth IRA article in ProPublica back in June 2021. So I thought I'd do another article / video on this. I actually just dropped a blog on this topic a couple weeks ago and thought, hey, this would be a really good topic for a YouTube video so people can try to understand the best ways they can use a Roth IRA to invest in a startup. So let's rock and roll. So before I get into some strategies, let's just go basic, right? The basic is, what's a Roth IRA? And why should you use a Roth IRA to do an investment, especially in a startup? So a Roth IRA is a type of an IRA. It's created in 1997 by Senator Roth of Delaware. Essentially, it is an after-tax IRA. So you do not get a tax deduction when you make the IRA contribution. But so long as you're over 59 and a half and the Roth's been open at least 5 years, when you take a Roth IRA distribution, it is all tax-free, right? So that's the game. Have some patience, make a really good investment, and then bang, it's all tax-free when you pull it out, so long as you're over the age of 59 and a half and the Roth's been open at least 5 years. So you could understand the strategy, right? If you have the opportunity to invest in the next Tesla or the next YouTube or the next Facebook or the next, well, I don't want to say Peloton, but you know what I mean. As the markets unfold, some of the companies that did really well during COVID are not doing so well now. But either way, if you think you can invest in the next great company, why not do in a Roth IRA? You don't have to pay any tax when you pull it out. And over the last 12 years, I've seen clients make a bundle of money tax-free in a Roth IRA, whether it's through publicly traded securities, over the OTC stock, private placements, cryptos, real estate, pre-IPO stocks, or just private businesses where they are invested in a business for a very low value, maybe at par, which could be pennies on the dollar, like what Peter Thiel did, or even $1 a share. And over the next 3, 5, 7 years, that went up into millions of dollars. So this stuff happens, and why not take the risk in a Roth IRA? So on the flip side, the risk is the company doesn't do well. It fails, doesn't materialize. And now your Roth IRA doesn't have that investment in it. And obviously that's the risk and reward you have to engage in mentally when you consider doing a Roth IRA investment. Yes, the reward is super high, or potentially could be super high, but the risk is you can lose your investment. So what are some tips you need to consider when you're looking to invest in a startup with a Roth IRA? Number one, you got to be under 50%. Internal Revenue Code section 4975 is clear. Your Roth IRA cannot invest in any entity where 50% or more is owned by disqualified persons. And a disqualified person is defined as you, as the IRA owner, or any of your lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such persons. So you can't invest your IRA in a startup that you and your spouse are going to own 90%, or you are going to own 99%. You need to make sure that all disqualified people own less than 50%. So in the case of Peter Thiel and PayPal, or Facebook, or Palantir, he owned less than 50%. There were startup founders. PayPal, Elon Musk was a startup founder. Same with Peter Thiel and other folks. They were under 50%. So that means, number one, his Roth IRA was able to make that investment. Okay. Now, I wanted to bring in a case which I talk about quite frequently, Rollins v. Commissioner, just to kind of give some flavor to the 50% threshold. Because like everything when it comes to IRS and tax law, there's gray, a lot of gray, different shades of gray. So this case, Rollins v. Commissioner, Mr. Rollins was a CPA. He owned a bunch of businesses, all under 50%. Okay, he was not an employee, just a investor, and it was a director in a few of them. Now, in these particular businesses instances, these companies needed money. So he took his 401k and he lent those companies money at prevailing interest rates. And again, he owned less than 50%. So on its face, you would think 49.75 is good, right? He's not violating the prohibited transaction rules. He's under 50%. He's good. However, the tax court came in, well, the IRS came in and reviewed the transactions and said, no, these are prohibited. These are conflict of interest. They're self-dealing. Rollins didn't make these investments. The benefit is retirement account. He did it to help himself out. And the tax court agreed. And they said, hey, Rollins, the fact is these companies needed money. And because they needed money, which is a very bad fact for this particular case, you use your 401k to bail these companies out, which indirectly helped you out, because without those 401k loans, potentially those companies could have went bankrupt, and thus you could have lost your personal investment. So the tax court agreed with the IRS and argued, and the IRS argued successfully that these transactions were prohibited. But if the facts were different, maybe if Rollins was able to show that there were 5 other investors out there willing to lend the company's money, or the companies were not in financial distress, they just wanted more money for future investment, and this was a really good loan for the 401k. Those facts didn't materialize, and unfortunately, the tax court agreed with the IRS, and they were prohibited. So when I say 50%, it doesn't mean it's a black and white number. There's gray. So you can do an investment where you may own 25% that the IRS can still argue it's self-dealing. Now, in the case of Peter Thiel and PayPal and Founder shares, Peter Thiel only invested less than $2,000 into PayPal, which turned into close to 30 million. Why? Because the par value on these shares were like 0.001 per share. So he actually only invested a couple grand, which turned out to be a very small percentage of the overall PayPal share. So he was clearly under the 50%. And Peter Thiel would easily be able to show that, hey, the $2,000 I invested in PayPal was irrelevant, right? It was not a conflict of interest. It was not self-dealing because PayPal didn't need the $2 grand, right? It was just a really good investment for my IRA. So that brings me to point number 2. Once you've comfortably believed that the 50% threshold will not be violated, and you believe clearly that you can show that the Roth IRA investment was done to help the Roth IRA exclusively, not to personally benefit you or any disqualified person, then we get to the second tip, and probably the most important: valuation. You need to be able to show that the value your Roth IRA is paying for the shares are fair. And this goes back to a Government Accountability Office report in 2014 that the IRS or Treasury prescribed and made public, talking about founder shares. And one of the key points they discussed was value. You need to be able to show that the Roth IRA is paying fair market value for the shares, so that it's clear that there is no benefit being presented to the Roth IRA that is not being presented to other shareholders. So in the case of Peter Thiel, he was able to show that, hey, my Roth IRA paid the same value as the other founders. So that's an important fact. A bad fact would be Adam spent $100 a share on May 15th, 2022, but on May 20th, 2022, the Roth IRA spent $1 a share. Not a good fact. Now, hey, maybe you can show that there's different levels of shares, right? There's maybe a common with voting. Maybe there's a common with non-voting. Maybe there's a preferred share that only gets paid out on a super capital event or a certain event, and maybe those shares should be valued lower. Those are all fair facts, but those are things you need to think about, because you want to be able to show that the Roth IRA is paying fair value for the shares. Okay. The IRS even admitted that this is difficult, right? These are privately held companies. A lot of them are startups with no goodwill. There's no inherent value in these companies. They're essentially shell companies. So it's hard to show what the value is. So what the IRS relies on is essentially what you're raising money at, what other investors are paying for the similar shares at similar time periods and essentially what your marketing materials look like. So you want to be able to show that, hey, my Roth IRA paid $1 a share or a penny a share. And at the same time, Joe and Harry and Jane and Lisa also paid that same value for their shares. Whether they use a Roth IRA or not should not matter. Everyone should pay the same value for the same like shares. Again, there are opportunities to have different values for different classes of share based on voting or preferred, but you want to be able to show that whatever class of shares the Roth paid for, the other investors at the same time bought similar shares at similar values. Okay, that's super important. Just as important as the prohibited transaction. The prohibited transaction, there's some gray, which I talked about. Yes, you need to be under 50% on its face. Even if you're under, there's some wiggle room there. You still can run into some IRS issues potentially if you don't have good facts to show the Roth IRA investment was made exclusively to benefit the Roth IRA. But even if you can pass that threshold, you still want to be able to show that everyone's paying, or your Roth IRA specifically, is paying fair market value for the share. So what do? You want to be able to show, and you want to have evidence that other people are investing at the same time at the same price. So you want to encourage other investors to buy shares, even if it's very few shares, at the same value at that same time. Okay, so if you maybe are going to own 30% of a startup with a bunch of other people, you want to be able to show that your Roth IRA, when it is buying stock, other investors, whether they use Roth IRAs or not, are coming in at the same time, paying the same value for those shares. That is super important. That's what saved Peter Thiel, other than there's a 3-year statute of limitation for the IRS to attack IRS prohibited transactions. That was ultimately what saved him, because by the time they got after looking at Peter Thiel and his Roth IRA, the 3-year passed. So they really couldn't do anything about it. But they still kind of used it as a case study. And valuation is a big concern for the IRS. It's a concern on requirement of distributions. It's a concern when people invest in alternative assets in an IRA, because alternative assets in some cases are harder to value than mutual funds or Tesla shares, which trade on publicly traded markets. Company XYZ and company ABC, you can get 5 different valuation companies to give 5 different values. It's possible. I've seen it. So what you can do is provide evidence and supporting evidence to the IRS if you were audited that, hey, my Roth IRA paid fair value for these shares. Okay, so having other people, non-retirement accounts, non-related parties, independent persons coming in to the investment and paying the same value for the shares at the same time is super crucial. Probably I think, necessity that every Roth IRA investor should make sure they're doing, especially if it's a closely held company. If your Roth IRA is buying Google stock, Facebook, doesn't matter, Meta, whatever, publicly traded. I'm talking here startups, private startups. You want to, number one, be under the 50%. You want to make sure that the IRA Roth is paying fair value. Have other investors come in at the same day, buy the same shares, same price. Now, your Roth IRA may buy 100 shares. Joe may buy 50,000 shares. That's fine. The par value, the per price share needs to be the same. You don't want to show that the Roth IRA is getting any benefit that other investors are not getting. Okay. So those 2 points are super, super important. Super important. The third, I think, is don't be a pig about it. Don't put $1 of shares to the Roth IRA at a par value of 0.000001 so that the Roth for $1 is getting 10% of the company, and a month later you're getting other investors at $100 a share. Be smart. Don't be piggish. Pigs get killed. Understand that the IRS may look at this, and if the IRS sees that your Roth IRA paid $1 for 20% of the company, it's not going to look good, right? So sometimes put some money in. If you believe in the company, hopefully you do, add some risk to it. Risk profile is good. Yes, you may lose more money, but you also will be able to show the IRS that, hey, this is not a sham, right? It's not like my Roth IRA put $1 in for 10% of the company, and then a month later I'm selling another 10% for $1 million. Doesn't look good. So make sure your Roth IRA is putting some money in. I'd say thousands, better than hundreds. You want to show risk at loss. You want to show that The Roth IRA is actually risking something. There's some economic substance to this transaction. It's not a sham. And yeah, the gain, the reward may be super high, but there's risk. It's not just $1 to make $1 million. It could be 10,000 to make $1 million. That's a better supporting fact. I just talked to a client a few days ago, and he was saying he was going to do one of these structures. He had an opportunity to put in like $100 to take 30% of the company. And I'm just like, hey, you really want to do that? Put in 10 grand, right? Make the share prices higher. It doesn't look good putting in $100 to take 30% of the company and then going to raise millions of dollars from the public for 30% more of the company in a few months. It just doesn't look good. So you want to make sure, again, that whatever your marketing materials say per par price, per share price, for specific shares, your Roth IRA is paying that exact amount. That is going to be super important if you do get audited to show that, hey, this is real risk and reward proposition. There's real substance here. It's not a sham. This is a legitimate transaction that needs to be respected by the IRS. What else to consider when you are looking to invest in a startup? There's something called a ROBS, a rollover business startup. If you want to invest more than 50% of value in a company and be involved, a ROBS will let you do that. A ROBS, called a rollover business startup, is a little bit different than a Roth IRA because you need to use a corporation, not an LLC, let's say, and you need to use a 401k, not an IRA. Now, 401ks could be Roths, but you can't roll a Roth IRA into a 401k. That may change. The Senate is currently reviewing the Secure Act 2.0, which was passed by the House, and there's some opportunity there that the Senate may allow in the future Roth IRAs to be rolled into Roth 401ks. But as of today, you cannot do that. So let's say you have a couple hundred grand in your IRA and you want to invest in a business startup, but you're going to need to own more than 50%. This is what you can do. You're going to have to use a corp, not an LLC. So you set up NewCo. NewCo sets up a 401k, NewCo 401k. You roll the 100, 200 grand from your IRA tax-free into NewCo 401k. You then convert it in the plan. So let's say you convert all of it. You pay tax on the 200k income tax, or maybe you just convert 50k, whatever you decide. And then you have the 401k buy the stock in the company. In return, the 401k gets shares. So maybe it's going to own 80%, 90% of the company. The 200k goes from the 401k to the corp. The corp then takes the money, buys the business assets, or invests in the business. The 401k, as I mentioned, Roth 401k, right? Because you did the conversion, owns a good chunk of that business. You become an employee, you run the business as you would any other for-profit business. But what you've been able to do is you've been able to use your retirement funds tax-free, penalty-free to invest in the business without having to take a taxable distribution, thanks to 4975D13 of the tax code, which allows a 401k to buy qualified employer securities, corporate stock. And you've just used those funds to fund a startup. You become an employee since you're a participant in the 401k. And hopefully when you hit a home run and you sell the company shares for lots of money down the road, all those funds go back to the 401k tax-free. So it's essentially a supercharged Peter Thiel. What Peter Thiel was able to do in a Roth IRA, he only needed a couple $1,000, right? He basically just used a couple thousand to invest in PayPal. But a lot of startups need more than that, okay? And if you're going to need more than maybe 6 or 7 grand, that's the IRA contribution limits, or maybe you only have 50 grand you want to spend, or you need more money and you want to be more controlling and you want to have more than 50%, then the ROBS will let you do that. Again, Peter Thiel didn't need the control. His Roth IRA bought a small percentage of the company. But because of the value of the stock was so low, he was able to accumulate a lot of shares, still under the 50%. But the price he paid was super low because of the timing of the purchase. But if you're going to be in a situation where you're going to need more than 50%, then the Roth IRA Thiel strategy may not work. So you go into a ROBS category where, yes, you have to use a corp. There's 21% corporate tax, whereas an LLC, there's a flow through. There's no entity level tax. There's a member level tax. But if your 401k owns a corp, there's still only one layer of tax because the retained earnings in the corp can be dividend up to the 401k without tax. And if you're able to use a Roth 401k because you do a conversion in the plan to go Roth, then you can still be exactly where Peter Thiel is, use more money, be involved in the business, own more than 50%, and hopefully hit a home run tax-free like Peter Thiel. So the only downside is you have a 401k, which means that if you have employees, you have to offer them 401k benefits, potentially a 3% safe harbor match. Yes, there's small administration fees for 401k, $1,000 to $2,000 a year, not a big deal. But that also lets you participate in the 401k. In 2022, you can put in $20,500 or $27,000 in a 401k. So you also get the benefit of that. Plus, you can retain key employees. 401ks are good stuff, but it's just something you have to use. Plus, you need to use a C Corp versus an LLC. Those are the only two downsides of Robs. Otherwise, you can supercharge Peter Thiel, use more money, get more than 50% ownership, stay in the Roth world, and still hit a tax-free home run. So you got the Roth IRA, you got the Roth 401k Rob strategy, two amazing ways that you can use a Roth IRA to invest in a startup. If you need to be under 50%, you're going to be passive, just do the Roth IRA. Easy, cheap, great solution. If you're going to be more involved, over 50%, Roth IRA likely won't work because of the prohibited transaction rules under 4975 of the code. So you're going to go the Rob's route. You're going to do a corp, 401k, do a rollover tax-free into the 401k, conversion in the 401k. 401k buys corporate stock. The corporation gets the cash. 401k gets the shares. The Roth 401k gets the shares. Buy the business, work your magic, sell it in a bunch of years. All the capital gains, no tax. It all goes back to the Roth 401k without tax. And once you're over 59.5 and the Roth 401k has been opened at least 5 years, it's all tax-free. All distributions go out of the Roth 401k tax-free, and you are a tax-free millionaire, hopefully. So there's some solutions, some things to ponder if you are looking to invest in a startup. Passive, you have the option. If you're active, you can go Robs. You can still go Roth IRA if you're active. Just stay under the 50% threshold. And obviously, understand valuation. So important, super important. Make sure when you are buying the shares, there's other people at the same time that are buying shares at the same value, same par, same fair market value. So you have evidence and support to show that, hey, my Roth IRA did not get a sweetheart deal. This is legit. There's economic substance. This is fair market value that my Roth paid for. If you do that, you're under 50%. It's going to be awfully hard for the IRS to attack your transaction. If you don't believe me, you can read the 2014 GAO report. They admitted in there that, hey, these transactions are tough. They're privately held companies, tough to value. Prohibited transaction rules are tough to understand, tough to uncover. And with the 3-year statute limitation, not a lot of time for the IRS to catch you. So really interesting strategies. I've seen clients over the years do remarkably well with it. Yeah, not every startup succeeds. Obviously, that's the risk. But if you're putting $4,000, $5,000, $6,000, not the end of the world. If you got to put in more, understand your risks, right? Startups are risky. Not everyone turns into a publicly traded company. A lot fail, right? There's probably 50 to 60% fail within the first 3 years. So understand your risks, do your research, understand who you're investing in. If it's you, then obviously you're investing in yourself. So you're betting on yourself, which is great. I believe in that. I believe in the power of entrepreneurship. It's what made this country what it is. It's what I believe in. My father was an entrepreneur. I'm an entrepreneur. I hope my kids are entrepreneurs. It's exciting to build something and to be able to do it in a Roth IRA and generate tax-free growth, even better. Did I do it? No. When I started IRA Financial, I wasn't smart enough. Even though I was a tax lawyer, master's in tax law, didn't understand the power of the Roth IRA. Trust me, if I start a new business at any point going forward, I will have a Roth IRA as the somewhat an owner, whether it's a small percentage or up to a larger percentage under the 50% threshold. I will 100% do it. So I made mistakes too, but hopefully that's the whole point of these videos, to educate you so you don't make those mistakes. You can be a smart tax lawyer, invest in the startup, think about using a Roth IRA or potentially a Robs with a Roth 401k, lock in tax-free growth. So if you do hit a home run and turn your business into a smashing success, you can do it with tax-free growth, which, trust me, it must feel so good to get those funds into a Roth IRA tax-free. And then maybe you only have to wait a couple of years, to tap into them and never have to pay income tax on those gains. Wow. So hopefully you will experience that and share it with me. So thank you for watching today. Hope you guys learned something. It's fun video. And again, if you guys have comments or thoughts on upcoming video ideas, you can email me at info@IRA Financial or hit us up on social media. I would love to hear from all of you. And I try to do these every Wednesday. So don't worry if you can't make it. You're busy doing other things, traveling, whatever, work happens. Just check out our YouTube channel, subscribe so you'll get notifications when I go live. And then you can watch the video anytime you want. And hopefully you'll pick up a few things that will make you a smarter and more successful self-directed retirement investor. So thanks for watching. Be well, take care, and until next time.